Hi, everybody. This is the weekly recap for the markets for last week and what to keep an eye on this coming week. So, the Navigator model portfolio is up 28.3% year to date, with really strong momentum and performance over the past couple weeks. You can see the benchmark iShares Russell 3000, which is the index for the broad market, is up 16.5% year to date as of the close of December 5th on Friday. The model is performing as expected, with the broad sell-off back in March, April, with the Liberation Day and Trump tariffs. All markets, including the model portfolio, sold off about between 13 and 15%. While the model was in cash for the next couple months, the market rebounded really quickly. The broad market, I should say, rebounded really quickly, with our model catching up and significantly outperforming in the latter half of the year, especially in Q4. And as you can see, really taking the lead here going into year end. Taking a look at what's coming up this week, we have a few job readouts earlier this week. Consumer inflation expectations on Monday. Tuesday we have JOLTS openings and job quits. And then on Wednesday is a few look at the housing market data, mortgage rates, mortgage applications, refinancing index, purchase index, and then we get the Fed rate decision on Wednesday afternoon along with the press conference. So that'll be a thing to keep an eye on. Many headlines suggest the economy is weakening and the Fed should be cutting more than it is. Others suggest the economy is strong and resilient and the Fed should be raising rates. I don't think anybody knows what's going on, but we're going to keep an eye on the trends, keep an eye on the tides and the wind, as it were, and follow our framework, follow our model. Another thing to keep an eye on this week will be liquidity. What you're looking at here is the SOFR rate, the secure overnight funding rate, minus the effective Fed funds rate. This is just an indication of how well or how liquid the funding markets are currently. This is the overnight rate. And you can see it's been trending upwards, meaning there has been an increasing amount of funding stress in this overnight market for the past couple months. And this is certainly a concern for risk assets. Now, we're not sure where this is going to go. The Fed does have the standing repo facility to address any concerns. But as Michael Howell will point out, Michael Howell of Cross Border Capital and his Global Liquidity Index, if you're not following him, please do so. I recommend it highly. He suggests that the amount of debt refinancing that's coming up in 2026 and 2027 will far exceed the amount of liquidity that's currently in the market. And that's the concern. As far as what the bond market has been pricing in, you can see, taking a look at the big picture here, the U.S. 10-year yield certainly in a downtrend, the 50-day moving average well below the 200-day moving average. There's been a bit of volatility, at least a lack of direction here over the past couple weeks, with the 10-year yield moving up, potentially breaking a downward trend, but we'll keep a close eye on this. My gut tells me that with the weakening economy, especially the weakening cyclical economy and leading index, we're going to see this continue to go down and go lower. But we'll certainly keep an eye on it and see what the bond market is pricing in.